Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, make your own financial decisions. Today is Wednesday, October 12th, 2022, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are just going to take a look at the state of the markets and just have an open discussion because trading has not been going that rosy for us lately, and it's kind of frustrating, and we're just going to chat about it today. But before we hop to this week's episode content, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, a few of the other Blockhead traders. Let us know what you're trading. Let us know if you're finding any pockets of profit out there in the world. You can also find all of my trades posted at thetagang.com/sprocket 888, the good, the bad, and lately mostly the ugly. You can also catch Blockhead Traders wherever you get your favorite podcast. And if you can't find it, leave a comment, let us know, and we will get it there. But let's hop to this week's content, Viper. Viper, the markets. I know we've dabbled a little bit in crypto here. I have been getting back in the equities market, and it just seems like we are in a forever slide to the bottom. We're going to zero, is all I can figure. We got tomorrow, CPI number coming out, which, by the time you watch this, it will have already come out. But, I'm expecting the market's either going to take off like a rocket ship or sink like a stone. And it is just, I'm personally frustrated with my performance this year in the market. I seem to just be on the losing side of everything, which might be where most of our viewers find themselves as well. And if you're not, let me know what you're doing, because I want to do something different. We chat about this all the time, and a lot of people have told me, well, it's really easy. Just take a short. And I'm like, I don't view that as just as easy. I mean, conceptually on paper, it's kind of, you get it. You're just playing the opposite direction. If you're not familiar with a short is basically when you borrow stock from your broker and you immediately sell it. So you basically sell something you don't necessarily have. So if a stock is trading at $100 and you want to short it, you immediately sell that. You borrow that share. You immediately sell it on the market for $100, and you're betting it's going to go down. So you wait till it goes down to, say, $80 or whatever your target is, and then you buy it back for $80. Then you take that stock and you return it to whoever you borrowed it from, your broker, and you have just made $20 because you got the $100 when you sold it initially, but then you had to give $80 back to buy it. That's called covering your short. And it's really the same mechanic of going long, right? If you go long, you buy a stock for $100, you wait for the stock to be valued at $120, and then you sell it and collect $120. Seems simple enough, Viper, but I personally have such a hard time in my mental state of comprehending this and playing this. And I think it stems from a couple of things. The first thing is I do option selling. So to me, shorting is very similar to selling a call. And that's actually a leveraged action. So things are amplified in that case versus a straight short from the market. The other thing that I have a hard time getting my head around is a lot of times I'm only ever in trades for, 30 to 40 days. So they're very short term. And one of the things that is very characteristic of stocks that are in a downtrend is they can whipsaw back north really fast. And that I just have a hard time, because if I end up shorting at that low point, which is probably where I would do it because that's just my luck, then immediately the stock turns around and you're like, why didn't I take a long? And the last thing that I struggle with is if you look at any equity, any share, any index, it generally goes up over time. And so, at least in my brain, I feel like shorting anything is playing the anti inevitable game, right? It's stocks typically go up in the long term. So shorting is almost like fighting that trend. And I have a hard time with that. These are my struggles, Viper, with why I find it so difficult to take what seems like such simple advice of, well, short it.
Yeah. And I mean, so as our viewers know, I've been on the tortoise's path of getting back into equities because honestly, what is there to rush back to right now?
It's true.
It's true.
But also, like, I mean, I'm also now, I mean, a little bit of more real talk of that is the reason I'm still persistently getting back in is that whole playing the averages. I've called it out before that when I left just before everything crashed, that was pure dumb luck. Like that was we went over that before. So nothing about that was calculated. But now we're down as far as we're down, and I'm looking at everything going, I gotta get back in playing that law of averages. Like they say, over a 20-year time span, or maybe it's 30-year time span, if you left money in, actually, I think it's like back to 1930 or something like that. You left $1,000 in the market in 1930 through today, it's, like $1.2 million or something like that, never touching it. And if you go back and just remove the top 5 worst days of the market, all of a sudden that $1.2 million goes down to like $60,000, something like that. But obviously, I'm sure that's recorded somewhere. I should have actually pulled it up. Those numbers are not accurate, but the shock factor of it is. And that's to say, that's why I'm getting back in, is because you need to be in it in order to get through it. But ever since I've started my DCAing back in, I as well am just down, 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 and I'm going, why do I just keep kicking money into this hole? But it's also because you don't know where it's going to turn around. So I agree, and there is a huge stigma around shorting, and it takes a while to break, and it's not unfounded because, I mean, like you said, there's a lot of factors. Like, first of all, you have to understand the underlying mechanics. Like, it's not just, I guess I'll say it anyway, it's not just as simple as longing, and there's certainly some discussion around whether it actually is or not, but still, the underlying mechanics, like you said, you're borrowing this thing. This is all done automatically, so to the button pusher, it's the same thing. It's like, I want it to go down, so I push the red button instead of the green button. But the underlying mechanic is important because what happens when a bunch of people long, we know the price goes up and slowly people exit, and the price kind of reacts a little bit as people exit. But price is going up. You longed it, going up. What happens to you if you short? Obviously, as price goes up, you start to lose your money. But more importantly, is what we want to focus on is what happens when the herd starts to do that. When everybody starts to do that. And that starts to create these scenarios that kind of induce some of this fear of shorting, where a short squeeze could happen. And this has obviously been in the news several times over the past year, and in some cases to extremes. But in the short squeeze scenario, a bunch of people are shorting. It doesn't even have to be anything you've heard in the news with Wall Street bets or anything like that. Just in general, a bunch of people could just start shorting something, and that puts a ton of short interest on a particular stock. And so I assume this also kind of plays into some of your fears. I don't know if you want to kind of go over a little bit of what this short interest means or does.
Yeah. So basically, the short interest is the number of shares that have been borrowed and basically sold short. And what that creates is almost an amplified buying potential. And what I mean by that, you might say, what do you mean amplified buying potential? The stock's going down. Who's going to want to buy that? So what ends up happening, and that is the creation of this short squeeze, is buyers come in. Maybe not the people that shorted it, but just people that said, okay, we've now reached a value that I think this is a good fundamental play. So you get the value investor coming in saying, okay, this is now at the appropriate valuation level. So they come in and start buying it. What that ends up happening is that will end up ticking the price up a little bit. And those people that shorted it, they start kind of freaking out a little bit because now they're going to start losing money because price is going the other way and they shorted it. So they're going to start doing what's called covering their shorts, which means they got to go to the market, buy back the stock so they can get out of their short position. Well, that creates buying pressure again. And the value investors are still there buying. So now you've got more buying pressure, and then this starts to move, right? It starts to go up, 1%, 2%, 3%. This is now attracting attention. So more buyers come in saying, hey, this thing might be a good time to take a long on this. And so they get in. And then the price goes up more. And now other people that were shorting, like, wow, this is getting serious. Maybe I'm ready to exit out of this. And this is what kind of brews that short squeeze, because now more people that were shorting it start to cover. And so the higher the short interests, the more potential short covers are out there. And every time somebody goes, when they cover a short, it creates more buy pressure, which basically creates upward price movement.
Yeah. And picture it as a waterfall, as dominoes, or popping, bubble wrap. You start popping it and just start like it just starts cascading. And some of this is not even just people FOMOing out or not really FOMO, but fudding out of like, this is too much. I gotta get, like, this can cascade on triggered orders, limit orders that have been sitting out there, stop orders, stop losses of all of a sudden these automatic orders are getting picked up, and then that is accelerating it itself. So I think it's important though, because while we do very much want to paint caution around this mechanic of shorting, ironically, at least a message that I want to try to put out is that, it's not all bad. It's not like, oh, you shorted it. Oh, you're really ballsy, man. Like, you're like, it doesn't have to be. It can be a very legitimate tool to make profits in this market. And then combining the two tools, make profits in any market. But I want to call out, and then let's look at a chart real quick of like, okay, so what is like a worst case scenario? And so I got this Etsy chart pulled up here. So obviously we know if we're longing something, our worst case scenario is we go long on it and we're a ding dong and we didn't put a stop loss on it and we left the country or something, and it literally goes to zero. So 100% loss. That's how we lose 100% of the money we put in. However, that is a contained risk of you will only ever and always only lose only the money you put into it. So in the short scenario now, we want the price to go down, but if the price doesn't go down, it works very similarly, just in reverse. So we go on a short, and what our 100%, just to match the long scenario, our 100% loss is double the price. So let's go up here to 212, somewhere around here, and drop that. So price swinging in a short from current price all the way up here to 213 is our worst case. That's not our worst case scenario in shorting, but that is we lost all the money we put into it here at 212. Longing, obviously in the reverse, we lose it all when we go 2-0, literal zero. And obviously this 212 is not out of the question per se over a long enough time frame. We were clearly here for quite a while. So where things get dicey is, how do we get there? And then what happens if we go past it? Because if you're shorting, you still owe this stock back to your broker. And so let's say you have $10,000 in your account and you only did one stock here, your brokerage is going to be totally cool with you just leaving this short open. And if price keeps going all the way up here to this 309, 311, like now you're losing even more money. So it was $106 that you had, you lost $106 here, but now you're losing like $150, $160, and on it goes infinite until your brokerage decides, hey man, you're running out of your $10,000. We're calling you out and we're going to liquidate you. So the thing though is obviously like what could possibly move that fast, and catch you off guard. And that's a very fair, legitimate question. And that's also why shorting with a stop loss is absolutely critical, especially in the concerns Sprocket's raising here. But we do have these scenarios, these black swan events of people getting squeezed in the short squeeze scenarios. And so that is when things really get kind of dicey and you get these market halts where trading is absolutely stopped as a measure of the circuit breaker system that exists on the New York Stock Exchange, which was implemented in response to the various crashes in the 20s and possibly, I don't know exactly when they implemented the circuit breaker, but essentially it's just saying we don't want anything to cause a cascading effect across the market, and that cascading effect caused in panic selling or panic buying, I guess, because it also happens in the up direction. But basically they just say a massive move, and I believe it is 10% within 5 minutes. But we definitely double check that just search circuit breaker criteria for stocks. I believe it's 10% in 5 minutes. They halt and they just say, all right, whatever did that move. I mean, if it was the S&P, then the S&P stops. But if it's Etsy, then Etsy stops. Like they don't halt everything. They halt the thing that's moving the most because it's just a quick, circuit breaker in your house. Like something happened here. We need to understand it. Kill this before it sets off any triggering effects. So what happens is if you shorted this and then you got caught in a squeeze and the thing just jumped and flew past your limit. I mean, remember, your limit order doesn't mean you're going to get it. Your limit order says to your brokerage, hey, if the price gets here, would you mind giving me a fill at this price? And so in the squeeze, there's this cascade effect of orders coming in. And so your limit gets hit and your limit just goes in the ticket line, and then price keeps shooting up because there's 1,000 people in front of you. And then it halts. And so now you're stuck. And now while it's halted, people are submitting more tickets in. And so it just gets really ugly really fast. And you could go way past your stop. So if we take a quick look over here at the one and only GameStop. So on Etsy, when I had those two boxes there, that was kind of like, okay, fine. That's a huge gap. Like, 100%, $106 to $212. I mean, it's all kind of relative though, right? So over in GameStop, what did the doubling of price look like? I mean, so this mountain here, this was the infamous big short squeeze. Price went from $9.97 ish, $10. I mean, even before that, we got a huge bump from $4 to $10. The story I like to tell is I was watching this all unfold way back here. I had no idea what I was looking at. I think Sprocket and I even texted each other on this jump here from $4 to $10. I was like, what the heck is going on with this thing? And I was like, I don't know. People just think GameStop's going to work. I completely missed this whole thing because I had no idea what was going on. But that really doesn't apply to anything here. But we see these gaps here. So these were halts. I mean, this is the 4-hour time frame. We could zoom in. You could see it in more detail. But there were halts here. So if you, had shorted here, let's just use it roughly, $15, and if it gets to $30, you're in that full loss scenario. And it didn't take long to get to $30. I mean, this just rocketed, and you could have been really, really getting messed up here in this wick. I mean, remember, we're on the 4 hours, so this wick was not quick. I mean, this goes all the way up to $40. And so if this happens fast enough, if you didn't have a stop loss, or if your stop loss is getting lost in the list of orders, your brokerage could get really worried here, because they could be looking at your account size. And, if you didn't have enough margin to cover, if you got called out up here, they absolutely will step in and say, you know what? We don't like the risk here. Like, we took on a risk letting you borrow this thing. We're looking at your account, and you don't have enough to pay this off if it goes any higher. So they reserve the right to just straight up rip it out from under you, liquidate everything, and force you to take that loss so they can make sure they get their stock back, and now you're out. And one of the worst things in this particular case here was people realized the fine print. RTFM is a thing for a reason, because the brokerage, in the fine print of pretty much every brokerage out there. I mean, I know Robinhood got a lot of slack over this, got a lot of heat over this. It's everywhere. Everybody says it. They basically say, look, if we get nervous, we can change the rules on you, basically. And so, if they have some hard requirement of like, look, if you get within 20% of your account size, that's when we're going to liquidate you. If something like this is going on where it just gets real uncertain real fast, they step in and say, you know what, forget it. New margin requirements. If you're 40% within your account size, we're going to liquidate you, because we just don't know what's happening here. This is going to blow up or something. They're going to protect themselves. That's really what it comes down to. So that ends up getting really ugly really fast. But I mean, how often does this happen? Obviously you don't know. But that's where I kind of want to pivot into using shorts. I don't want to say properly, but at least using them more efficiently. So let's look into this a little bit deeper here. Let's jump to the index, because I mean, one of the things Sprocket said was there's just always this bias of the chart to go up. And so the fear of shorting, because you're feels like you're trying to catch that knife of like, it's going to do a quick reversal, but then we're back up. And so that's true. But what I want to break down is that means, like, if in that scenario, as it was just described, that means that you're shorting in a bull market. And if you're shorting in a bull market, you need to be fast. You need to, like, that 30-day horizon, forget about it. You're shorting in a bull market. This is the weekly. Let's go to the daily S&P 500 chart. I mean, look at this thing. Like, nothing is a short opportunity in a bull market over a 30-day period. We'll call it out here and just drop a 30-day box just so you can see. So this box represents a 30-day period on the chart. And just as we slide it around here, I mean, there's maybe one here. Like, and I mean 30 days, like, you don't have to be 30 days, but still, that's, Sprocket's time frame. That's what he's looking for in plays. You had one crash back here that, was almost 30 days, that maybe there was an opportunity to just run a full play in the pandemic crash in 2020. But generally, the market this is a bull market. And there's just not going to be that kind of opportunity to wait 30 days and get that. So that's point number one about when to short. And it's to make sure you're using the short mechanic when it fits the trend that the market is in. So I don't know how you feel about that, Rocket, as far as like, I mean, how many times that you tried shorting and we were in the bull market, or is it more recently, or does that play in at all to your short decisions?
Yeah, no, it's a good call out that you have, because, my trading career is relatively short. I started trading in 2019. More seriously, yeah, I dabbled before that, but I wouldn't call myself much of anything. And so from 2019 to, the most recent high of the S&P, it was largely a bull market. And so a lot of my exposure to things that I shorted in there was during a bull market. Some of my most notable shorts, I'll call it, that I just got run over. Snap was one of them. I believe Pinterest was another one. Soy disaster was another one. And all of those were definitely in a bull market. And so it's a great call out. And I was kind of going against the overall sentiment of the market. But
Yeah. So that kind of raises the question then of how do we know? When do we make that switch? When do we, because we do get official guidance of like we're in a bear market now, but it's super laggy, super delayed. There's all sorts of technical rules around what a bear market is. We've dropped X percent over X period of time. But none of that means anything because the market itself is always forward looking. It's always trying to predict the future price. So by the time we officially call a bear, you're way too late. But I guess you could wait for that if you want to, but that's where you might be pegging the bottom because we could be turning around. So I think it's important to call out. So let's just keep on the S&P here. What does that criteria look like? Obviously we had this big bull here, and to me personally, and I'm going to say it many times because it's worth saying many times, hindsight is always way too easy. But nonetheless, I would say, none of this market here, I mean, going way back, 2016, but, 2019, 2020 was when we both kind of really got in more seriously. None of this is a good environment to do any shorts outside of scalps. 1, 2, maybe 3 day plays, period. Get out because everything's up biased. But what does that look like? I mean, obviously going forward, we're like, well, this probably is it, what we're in right now. That feels, but how can we call this out as it happens? And so let's look at a couple things. First is the pandemic crash was ruled technically a bear market. And that was mostly because of this massive hit we took off the top. And so technically you could have maybe started looking for shorts, but let's look at what exactly needs to happen to make them, I don't want to say safe, but make them appropriate to look for. So what we want to look for is actual confirmation of a trend reversal. That's going to be key in all of this, is actual confirmation. And I want to drill on that verbiage because, as we see this crash in 2020, you could be like, wow, we're way down. We're down 15, 20%. This has to be it. Like, I'm going in, I'm going short. None of this first crash here is confirmation at all. None of it is. This is the move. You get confirmation after the move. And so what we look at here is, if I look at this was an all-time high here around 3,400 on the S&P. So when we want to find out what is official reversal from this all-time high. So as we start dropping, first of all, we lose, we'll zoom in a little bit, but it's not super important. But first of all, as we're dropping, we lose this local low, which was set before the all-time high. So that's step one. Okay, we lost that. So now we're at least downtrend, because we can be in a downtrend and not be in a bear market. So now we're in a downtrend. So what next? So so now that we're in a downtrend, well, what's the confirmation look like? We trace back on the swing here, and we go to the move that made the all-time high. We go over a lot of these terms in some of our price action videos. There's probably gonna be a lot more price action videos as we continue to evolve and learn. So don't ask questions in the comments or whatever on any of these terms. We'll definitely dig into them. But we go back to the move that set the all-time high, which actually happened back here. So if we draw a line here and just kind of bring that over and mark that, this is our line in the sand that we don't get trend reversal until we lose and then confirm that we've lost this level. And so what I mean by that is, if we zoom in now to the actual crash as it happened, we come down here. and we get a test bounce off of it. We come back up, and then here we lose it. Let me go really hot, call this out. Here we lose it, so we go down, but still we're not trend reversal. I mean, sometimes it feels this silly to be like, well, look at this, we're way down here, like this absolutely is a reversal, like, but look what happens. We come back up, and this is the key moment right here. We come back up to this level, and we give it a test. So you get a downtrend, just recapping, get a downtrend, lose the level, test the level. And then it's that test. So we're on step 3 before you get anything of confirmation as to what's happening right now. So we come back up here and we get this test, and we start kind of flirting around here and bouncing, but it's taken a few days, taken a week or so to figure out what it's doing, but we actually gain the level again. So now we've gone up, we come back, we give it a test, we go up again, we give it another test, and now we're kind of bouncing support here, and then all of a sudden we're off and running. So this for the long-term plays of shorts and wanting to feel more comfortable shorting, we never hit that. We never hit that criteria in this technical bear market, the shortest bear market on record, because we never actually lost that. So what it would need to look like is we'd come back up here, and if we bounced off it and rejected, now we've officially reversed trend direction, and now we're headed down. So real quick, jumping forward then, where are we now? Well, we're well aware that we're in a bear market now, but how did we get here? When did we know that we should be searching for shorts and stop wasting our money on longs? So same idea. I'm going to go through it kind of quick. Had an all-time high. I'm going to call this the move that set the all-time high. There's a little bit of, you could probably call it out up here. But it's nervous. It makes you nervous doing shorts and whatnot. So let's really stretch it down here to this swing move here that set this all-time high. So same idea of everything we just went through before. We come back down, we test, we lose, we gain, we lose again, and right here we actually get the loss. We lose the level, and then we test, and then we lose it. I mean, so you can kind of see this sort of happened here. So, I mean, I'm trying to keep in mind that you don't have all this data in front of you in real time as it's unfolding. So back here, we lose, we test. Like, this almost feels like maybe you're comfortable that the level's confirmed, the trend is confirmed. But over here, what ends up never happening in this first one that does happen over here, so maybe you'd still want more confirmation than this. Well, then right here is where you're getting that more confirmation. We lose the low that came up and tested this. So now we're in downtrend, and we've confirmed that we have resistance on this key level. So that is, if we put a date on it, May 9th, May 10th, somewhere around there, that we would be like, all right, now we're in a bear market. That was long before the bear market was ever called. And now we can start openly shopping for shorts. And you can see one of Sprocket's concerns is entering a short and it running away on you. So May 9th all the way through September 12th now. If you pegged the worst time to short in anything here, I mean, we're looking at the S&P, but the first time we hit down here, if you are, like me and get emotional sometimes and short the bottom, buy the top, all that stuff, you have decent opportunities to not get caught in some runaway up. This one would be a little tough here. This is a big run up to 4,200 again, but we do reject off of this level and we continue the down. And so it's a little safe. I don't like that word, but it's a little more appropriate. And even in this case, this is like, I don't know, super comfortable confirmation here when we bounce loss of this, and to take shorts on this run here, because once we tested and resisted off of this level, you can expect lower lows from where you just were, which is exactly what we got. 3,600 was what took us back up to 42. Now where are we right now? 35.77. We're making a lower low from where we were. So the takeaway in all of this is read the market, and that's why I think this S&P chart is very important, because you want to get a feel for the space before you go into anything.
It just makes a lot of sense, Viper. I mean, I guess a lot of my past exposure to shorting really probably came at you would call a more inappropriate time to short a stock. In particular, also a inappropriate time frame to short a stock. And to be fair, during that big bull run, I was experimenting at the time with scalping futures during the cycle. So, I mean, I would basically buy a future, let it run a couple of ticks, sell it, and then I'd wait for it to do a quick reversal of some kind, and I would short that future. I'd let it drop a couple of bars, and I'm talking like on the 5-minute time cycle, and then I would buy it back and make a profit. And I viewed it as, I think we even did an episode on it, scalping at the time. It was largely like a 50-50 flip. That I didn't see a ton of success. I found it kind of stressful, but I get what you're saying, where, the scalping is the more appropriate thing. But here in the chart that you have pulled up, we definitely are more in that overall bearish trend. Trend is down. And so you can see we're really far off that rejection. So where would you kind of expect price action? Like if I'm like, all right, Viper, let me go ahead and give this short another go, and we were doing it off of this chart, what would you want to see? Because you probably aren't going to retrace all the way to that first rejection before you go back down, right? Because if the trend is down, you trace up partially there or something. Like, what am I looking for from where we are today?
Which is important because, I mean, we walked through how to establish the bear, the big downtrend, all that kind of stuff, but you still need to know when to get in. I mean, even if you waited to this day to be like, I don't know, maybe I'll get into shorts now. Basically, so what I see here is, first of all, because this is an index, I mean, this would apply just on an equity, but because this is an index, I want to drive home the line of thinking that I want to look and go shop for shorts when the index is at a favorable point that it's going to go down, because the index obviously represents a whole basket of things. And so if the index is at, like this test that was up here and it was rejecting off of that, now this run here is the favorable time to go shopping for shorts in here because the trend is down from here. And I say that because we're now at a new low. So we've kind of, I mean, we've satisfied, I think that's the word I want to use, not completed, but we've satisfied this move, which was the rejection off of here said, you are now most probable to get a new low below this one. Technically, we're there. We're not done yet. There was no, low booked and then potential reversal. But I say that because now's not a great time looking at this chart to go shopping for shorts because we had this big move here. We've technically satisfied the move. So what I'd be looking for is, there's all kinds of different micro scales you can look at. Like this bounce here, maybe you would have been satisfied to start shopping when we were up here at 37.75, because on the price action on a higher scale, there's a couple things that we want to see. We want to make sure we continue to lose anything we've tried to gain. And so that was this whole test here. We lost it, and so that was big. So what's the next thing we lost on this? Well, the move that made this low here started right about here. And so what I want to see on a bounce back, on a retrace, I don't want to see a retrace that, if I'm still looking for shorts, I don't want to see a retrace that breaches this now 4160-ish range, because that's the move that set this low before we came back up. So I think I'm probably, on a big time frame, I'm thinking a retrace back to 4160 is not out of the question. This same logic you can apply to where you could, maybe not catch the knife, but maybe a couple of these little moves here you might have been comfortable jumping in on, because we could get into nitty gritty and find some thesis for those. But on a bigger time frame, where we obviously do get big retraces, I'm kind of thinking somewhere around there.
Okay, that seems fair enough. So basically, you're saying, hey, if you don't consider shopping for shorts until we kind of get the retrace up to that second line that you've drawn, and then if you reject off that, that would be a great time to look.
And the other thing I wanted to do real quick is let's clear this out. Let's do the old invert the scale. Because I don't know, this can be easier to chart. It's just it's that upward bias thing. So we had an all-time high here. The swing that made that all-time high came. I mean, this is basically what we just did. And actually, we can even bring this back a little bit further. But the swing that made that all-time high was right here, where we had this resistance. We gained it. We got support, and we went and set not an all-time high, a local high. So you can chart that and then flip it back, and all of a sudden, there we are again, right around that 4160 level.
Well, Viper, that's good insight. I'm not sure I have any capital in my account right now to short anything, but I definitely think I'll give the shorting another go if provided the opportunity. Maybe we can get a nice a bear market rally, I believe is what they call it. That's the violent up moves that we can get. Maybe that'll let me claw back some of my capital, and we'll take a look at where the market then looks for there, and maybe we'll go shopping for some shorts, and we'll see how that pans out for me. But until then, I guess I'm stuck in a lot of these longs. Couple option plays burning theta away. They're in the money, so they're not looking that pretty right now. That's the current state that we're in. This is a little bit of an anatomy of a short. So hopefully you guys learned a little bit of something. I learned a little bit of something for sure. Shorting is not something I'm comfortable with. It's definitely something I feel like I should be comfortable with. I just need a little more exposure, a little more trial at it. And looks like, I might get my opportunity at some point in the future. And so stay tuned, and we'll see if that opportunity ever arises. Otherwise, good luck out there for those of you that are braving the market and trading, whether you're shorting or going long. It is rough. The volatility is quite high. The VIX is well over 30. Lots of economic news and uncertainty out there coming out. So good luck, and remember, think outside the block.